property market. But Peter Escher, the co-founder of Wealthy, says that is actually the case. There will be a Biden effect. Plus, I'm sure there's even a Daniel Andrews effect with the Victorian budget as well. Pete, thanks for joining us.
Thank you for having me again.
All right, now Peter, just for our viewers, what does Wealthy do?
So Wealthy is a real estate investment platform, and basically what we do is we allow people to come in and build a property plan in 60 seconds, and then we help people match their profile with the right properties in the market.
Okay, so it's like a property matching service in many ways, isn't it?
Yeah, it's sort of like the Tinder for real estate investors.
You said that, not me. Anyway, let's deal with the Biden story first of all. Why do you think Biden and the US election generally can have effects on the Australian property market?
So Australia's been caught in a crossroads between the US and China's trade war. We've basically bore the brunt of threats, economic threats. And I think what's also happened is a lot of the Chinese investors that were coming into the Australian market and investing here have maybe shied away for a little bit. And so if we see a Biden administration that looks to ease some of those trade tensions, then you could potentially see some of those Chinese investors that have been looking at places like Portugal and Dubai and shying away from Australia, investing in Australia, potentially coming back. You've also got the impact of stimulus. I mean, $3 trillion of stimulus coming into the market. That's going to have pressure on rates. That's going to have pressure on inflation and asset prices. And so, they're the things that we're watching closely.
So do you think that Beijing has actually discouraged Chinese residents from investing in places like Australia?
I don't know if there's been a directive that's come from the top. I know, for example, anecdotally, that they have told parents to look at alternatives for their children's education. And, you know, those students that come here and study here, it's a bit of a gateway for the family to migrate here, and they buy real estate, and they can only buy brand new real estate because they're non-residents. And so that's propped up the market, for example. So there've been a lot of anecdotal signs, and we've actually seen in the market, one of the biggest problems a few years ago was trying to get access to brand new property coming onto the market. A lot of it was being sold directly into China and into Asia. And we're seeing a lot more availability for the local market now. And I think, you know, that's something that we're watching very closely to see if it reverses back to the extremes that we saw in 2015, 2016.
Right. What indicators will we be watching to validate your Biden expectations?
What we find really well, I mean, where we have a lot of value in the market is we have very good access to supply. And so we're screening supply. We're meeting with developers every single day. We're seeing what projects they're bringing online, what projects they have in the market at the moment, what their current residual stock looks like. And I think over the past couple of weeks, we've seen stock moving. So while at the beginning of this year, there was a fair bit of residual stock in the market and there were some great deals for investors, the developers in the market aren't as desperate as what they were 3 months ago, 6 months ago, or even 12 months ago.
Peter, what about the demand effects of the problems with some apartment complexes, you know, the Mascot one, the one at Homebush? What impact is that having in terms of demand for apartments?
Yeah, you're 100% right. So a lot of investors have looked to those anecdotes and those disaster situations, and that's what they are. They're disasters for somebody that's gone and put their life savings into something like that. And a lot of buyers are now looking for a different kind of product. They're looking for a house and land product, and the federal government's home builder scheme has actually put a rocket under the house and land market. Because if you have a look at Home Builder, how it's structured, it really incentivizes you to buy the land, settle on it, and build straight away. And so a lot of buyers have probably gone into house and land, but there's also what we call the missing middle, which is townhouse and villa style, where you can buy into a strata scheme. It is more cost conscious. It is more suitable for investors because you get the depreciation out of it. And they've definitely, we've seen developers producing more stock like that and bringing more onto the market. You've also seen developers looking at, instead of trying to pack as many apartments into one complex and sell 100 apartments, maybe they're building larger format, and instead of doing 100, they're doing 50 beautiful apartments and trying to target a big downsizer market with the aging demographic. So they're some of the factors that have fed in post Opal Towers.
Okay, what about the Victorian budget? You know, before we came on air, you made a point that it was a pretty good budget for not only real estate generally, but your business. So tell us why.
So I know a lot of the viewers that watch this program. There's a lot of them that have been waiting for a collapse, and they've been calling for a collapse since the beginning of the year. And you know, previously when I've come onto your program, I've said that supply is very important, and the governments will actually go to all measures to support the market. And so federally, we saw Home Builder. That really supported the market at a really important time, and that provided stimulus because, you know, putting that much money in and then the leverage around that makes a big impact on price. And I think what Victoria has realised is that their property market was at risk. And so what we saw in the budget this week is the Victorian government actually saying that on top of every other piece of stimulus, first home buyer grants, home builder grants, they're going to provide a 50% waiver on stamp duty for contracts entered into between this week and the 30th of June. And, you know, if you look at that, you know, average property in Victoria, or whether you're an investor or a home buyer, you're going to get stamp duty relief. And if that's worth 15, 20 grand, you know, 7 times that, which is what the banks are lending at the moment, that's about 150 grand worth of price support, which is about 20% of median price. That's very, very significant because a lot of investors have been unsure about the Victorian recovery, but now there's even more ammunition being thrown by the state governments. And New South Wales last week opened the door to cutting stamp duty altogether. And so these two things are massive for the investor market.
Yeah, Pete, what are you seeing in relation to enthusiasm to buy properties, particularly investors? Are you seeing in various states more enthusiasm than in other states?
Yeah, I think there are a lot of people that are unsure, right? So while we do come on and we paint a rosy picture because we fundamentally believe in the asset class, I think there are still a lot of people that have insecurity around their work, that have insecurity around their household budgets. But there have also been those people that have had cash and have been in a strong position coming into this year, and now they're looking at their term deposits and saying, you know, I'm getting 0.5% return on my money if I'm lucky per annum. The stock market's moved and the ASX 200 hit its highest level this week. And so there's a shift coming back to the real estate argument. ANZ went from predicting a 9% decline last year to a 10% increase. CBA CEO came out and said he was probably too pessimistic when they released their result. So the tide is changing, and those that have been in a position to move have moved already. Those that have been on the fence, there is less real estate concern today than there was 6 months ago. And we're seeing that in higher volume of people coming to platforms like us, for example, but also in the market. You drive past on a Saturday, an open home, and you're starting to see the lines again.
Okay, one last thing. We know that the travel restrictions has meant a lot of Airbnb apartments in Sydney and Melbourne just aren't being used. What's happening to the investors who own them, and are first home buyers, you know, starting to have a look at these apartments because their price may well be coming down?
I think that segment's still got a little bit more pain, Peter. I think it'll be interesting to see the impact of the borders opening on Queensland and Victoria and Christmas, and how much of that excess stock gets soaked up. Those that are bearish are going to say it's not going to be cleaned up, and people on the other side are going to dismiss it. And I think the truth is somewhere in the middle. There's probably 6 to 12 months of pain on the rental side still to go, and until we don't get our international borders open, there's still going to be a supply. There's going to be more rental supply, I believe, but that's 1 year in a 10-year cycle. And so anybody that has a 5, 10, 20-year time horizon can use this as an opportunity. And it's a great time to be renting. It's a great time to be renting your primary place of residence and, buying investments and renting them out.
So one last question then. Have you seen any evidence of investors who own these Airbnb properties in the CBDs starting to put them on the market? Of course, many of them will be trying to get into the longer term rental market, but are we seeing an increase in supply of those once investor-owned products coming on the market for auction?
There have been a lot of Airbnbs that have flipped back into more long-term rentals, as we call them, and what that's done is it's reduced the amount of rent. However, a massive offsetting factor has been the decline in interest rates. I mean, Westpac is now lending sub 2% on a 4-year fixed term rate. And so even if your rent has fallen 20, 30, 40%, interest rates have been a massive offsetting factor. And so that has forced investors that were playing that strategy to absorb some of the pain. There is pain out there, but it's not catastrophic, and the numbers reaffirm that.
Okay, Peter Show from Wealthy, thanks for joining us.